Imagine this. You work hard your whole life. You save every extra dollar you can. And finally, you decide to put your money somewhere safe. No risk, no drama, no surprises. Feels good, right? But here's the kicker. Quietly, slowly, legally, your money starts shrinking. Not because the market crashed, not because someone stole it. It's just how the system works. Honestly, most people never see it coming. That's the hidden cost of safe money, and almost nobody talks about it. Right now, trillions of dollars are parked in supposedly safe spots: savings accounts, government bonds, money market funds, pensions, reserves. These are supposed to be the padded rooms of finance. No sharp edges, no sudden shocks. But over the last few years, something weird happened. People with risky assets, stocks, real estate, businesses, they went through big ups and downs, and many of them ended up better off than before. Meanwhile, the people who stayed safe, they watched their money slowly lose value. Same economy, same currency, completely different results. So what's going on? Let's step back. Modern money makes a promise: stability. You're told that $1 today will still be $1 next year. You might earn a little, but you won't lose anything. Sounds fair, comforting even. But here's the uncomfortable truth. Money isn't made to sit still. It's made to move. Spending, lending, investing, taxes, borrowing, it all depends on money circulating. So when money hides in a safe spot, the system sees a problem, and it fixes it in the quietest, most predictable way. It makes holding it more expensive. That's inflation. Not the scary headlines or weird economic jargon, just a gentle, constant push. Inflation nudges you to spend, borrow, or invest instead of hoarding cash. And if you're holding safe money while this happens, you're not just standing still, you're losing. Let's make it real. Say you have $10,000 in a savings account earning 1%. Meanwhile, inflation is 4%. On paper, your balance grows, but in reality, your money loses about 3% of its buying power every year. No alarms go off, no flashing red numbers. Nothing feels wrong. But after 10 years, that $10,000 is only worth about $7,400 in today's dollars. You didn't gamble. You didn't make a risky bet. You just waited. And it's not just you. Banks, pension funds, insurance companies, governments, they all hold safe money too. When inflation hits, the losses scale up quickly. Now here's the part that surprises most people. Inflation doesn't affect everyone the same way. If you owe money, inflation actually helps. You can pay back debt with cheaper dollars. If you own assets, prices often rise. If you earn a paycheck, well, wages might eventually catch up, maybe. But if your money is safe, fixed, locked in, you're the one taking the hit. And here's the part nobody likes to say out loud. That's not a mistake. It's intentional. In a debt-based system, there's always more money promised in the future than exists today. Someone has to lose buying power for that math to work. Usually, that someone is the quiet, patient, safe money holder. It gets worse when interest rates are artificially low. Central banks often keep rates low to encourage growth. Borrowing becomes cheap, saving earns almost nothing. If you stay safe in that environment, you fall behind, not because you did anything wrong, because the rules changed. The irony? The safer your money is, the less control you have over its future. Cash doesn't adjust, a bond doesn't negotiate, a fixed payment stays fixed, even as everything around it moves. Meanwhile, riskier assets can change. Businesses raise prices, real estate rents go up, stocks reflect future expectations. Stability freezes you in place while the rest of the world moves. This trade-off used to make sense.
lower returns in exchange for peace of mind. The system moved slower, inflation was smaller, penalties were modest. But today, with huge government debt, aging populations, and pressure to keep economies growing, that trade-off looks more like a slow bleed. Governments rarely default outright, they inflate. Banks rarely fail depositors directly, they quietly reprice. Pensions rarely admit they're underfunded, they just adjust assumptions. Promises are kept in numbers, but the real value erodes underneath. This creates a strange trap. Being cautious feels risky. Being prudent feels like you're falling behind. Doing nothing becomes an active choice with consequences. This is why safe money often ends up feeding the very bubbles people fear. When returns on safety vanish, capital searches for anywhere else to go. Not because it's smart or productive, but just because it's something. Money flows into stocks, real estate, anything that moves. Prices rise, risk builds, fragility grows. Then the cycle repeats. Stability comes back by making safety expensive again. Here's the part that should make you think. Most people see inflation as temporary, a spike or a cycle, something that will be fixed eventually. But honestly, inflation is the system choosing winners quietly. It's quieter than taxes, less visible than defaults, and it hits hardest the people who trusted safe money. So what's the alternative? Truth is, there isn't a perfectly safe option. You can be safe from big swings or safe from slow erosion. Rarely both. Every choice is a bet on growth, policy, stability, or just time itself. The real risk isn't volatility, it's assuming that being safe actually means neutral. Next time someone tells you your money is safe, ask yourself, safe from what? Safe for whom? And safe for how long? Because the scariest thing about safe money isn't that it can disappear overnight, it's that it disappears so slowly you barely notice until years have gone by. And if safety has a hidden cost baked in, who's paying it next?